In the world of trading, one of the most powerful and widely used indicators is the RSI, also known as the Relative Strength Index. But what exactly is RSI and how does it work? That's what we are going to learn today. Welcome to PayFunds Academy, the educational playlist of our main channel PayFunds, where we provide you with authentic, knowledge-based and reliable information about cryptocurrency, trading and technical analysis so you can build confidence in your financial journey. RSI, or Relative Strength Index, is a momentum oscillator that measures the speed and change of price movements. It was developed by J. Wells Wilder in 1978 and has become one of the most important tools in technical analysis. The RSI moves between 0 and 100 and is used to identify whether an asset is overbought or oversold. So, how does it work? Generally, when the RSI goes above 70, it indicates that the asset might be overbought, meaning the price has risen too quickly and could be due for a pullback. On the other hand, when the RSI drops below 30, it suggests the asset might be oversold, meaning the price has fallen too sharply and could be due for a rebound. Traders often use these signals to make buying and selling decisions. The calculation of RSI is based on the average gains and losses of an asset over a specific period, usually 14 days. This formula creates a ratio of upward movements compared to downward movements, which is then scaled into a number between 0 and 100. Although the formula itself is technical, trading platforms automatically calculate RSI for you, so you only need to learn how to read and interpret it. But RSI is not just about the 70 and 30 levels. It can also be used to spot divergences. For example, if the price of an asset is making new highs but the RSI is not, it could signal a weakening trend and a possible reversal. Similarly, if the price is making new lows but RSI is not, it could mean that the selling pressure is slowing down. However, RSI is not perfect. It should never be used in isolation. Sometimes, in a strong uptrend, RSI can stay overbought for a long time, and in a strong downtrend, it can remain oversold. That's why professional traders often combine RSI with other indicators such as moving averages, support and resistance levels, and volume to make better decisions. In summary, RSI is a simple yet powerful tool that helps traders identify potential entry and exit points by analyzing the momentum of price movements. It is an essential part of technical analysis and can give you valuable insights if used correctly along with other tools. That was today's topic, RSI and how it works. If you found this information useful, make sure to like, share, and subscribe to our channel for more genuine knowledge about crypto trading and analysis. And remember, PayFunds, your keys, your crypto, your freedom.